Welcome to this episode number 60 of your next trade called today Global Easing. So last week we looked at the potential fading of the momentum, where we saw that over the last 2 to 3 weeks before, momentum stocks were taking their breath. And guess what? The market is giving another leg up. We are talking risky assets, we are talking risk on. And probably the biggest reason of them all is central banks are expected to be accommodative again. So if we look at 2024, looking at the central banks, as we can see, the numbers of cut rates that are expecting for this year have been pretty significant. The only time that we had that much accommodative central banks was in 2008, 2009, where we had the great financial crisis. So the same question that we had on Wednesday. If we have an economy that is still growing around 1 to 2% for the world economy, or let's say 2 to 3%, if the US are growing, even unemployment rate is below 4%, why should the central banks be that accommodative? The question here is probably, are the central banks that much oriented towards inflation? Are they that independent? It doesn't matter. This is a risky risk-on assets market, and assets are going up. So if we look at the year-to-date asset performances, if we look at stocks, now S&P, Nasdaq are roughly up 10%. Japan is up 20% plus. Europe is very strong as well. So we are roughly FX adjusted at 10% versus the same level for the US. For the currencies, a bit of strengthening of the US dollar year to date. Crypto still up 50%. If you look at the commodities, all commodities, not all commodities, but gold, WTI, copper have been up. Week to date asset performance, this is the big story. So we get the S&P up 2% plus, Nasdaq 3%, Japan up 6% for the week. So overall, that has been a risk on. As we discussed last week, the market was taking its breath, waiting for the central banks that we had for the week. So we had on Tuesday the Bank of Japan, which is going to be ending negative rates for the last 20 years or so. But don't get me wrong, the central banks, the Bank of Japan is still very accommodative. We had on Wednesday the Fed with Powell, despite higher inflation expectation, despite higher growth rates, was pretty dovish, and the market obviously liked it. If you look at now the US dollar, actually that was a funny one, because many expected, if you look at many Substacks comments just after the Fed, it was about, the dollar is going to be weakening. First reaction just after the meeting was that, but on Thursday and Friday, actually the US dollar keep on strengthening. So I think this is where the pain is coming for some people. Crypto, actually, if you believe that it could be some leading indicator of the risk on, risk off, Bitcoin, Ethereum have been struggling. WTI flattish for the week, copper down for the week. And I think this one is interesting, both the copper and looking at the this one, which is the dollar versus the Chinese yuan. As we're going to see later for the technical analysis, there has been a bit of a move from the Chinese yuan, a bit of weakening. So are the Chinese trying to play the FX play to kind of push up the economy? That is probably one of the drivers going forward. Don't look too much at the year-to-date industry performance, but look more about, where is the week. This is for the S&P. The winners are still winning. Semiconductors, second one, home builders, very strong. Again, other end of the spectrum, we had silver and the gold miners. Why? Because technical analysis, we see there has been a bit of a fake move and actually a bit of a reversal for the gold on the week. Week to date sector performances, only real estate was done on the week, but overall this is a risk on. S&P that is here, telco, IT, industrial, so even the cyclicals have been doing pretty well. The one that have been underperforming have been, healthcare, utilities, consumer staples, guess what? That is the one that I'm a bit more defensive. So really a risk on week. What about the rates? Looking at the US 10 years, the 4.2 level. I don't do technical analysis on US 10 years, that has been the big level. The 4.2, we have been saying 3.8, 4.2. We have been trading around this 4.2 level for quite a long time on the US 10 years. We have quite a decent week in terms of new supply bonds auctioned for this week, when we're going to be looking at the next catalyst. So that explained a bit of the supply going forward. The 10 versus the 2, we are still at minus 37 bips. So there was a bit of similar on many substacks after the FOMC meeting, saying, this is the steepening, I'm going to be making a bit of money. Look, I sent you this tweet like 2 days ago. Steepening didn't last that long. 2 days later, we are back to where we were before the FOMC level. So if you look at most asset classes, they are back or below the levels that we had pre-FOMC on Wednesday, except stocks. So stocks, the momentum is still very strong. What about the Fed expectations to the Fed fund rate? So Fed fund rate these days at 5.33. If you look at December 2024 for the year, so the difference is 0.73, so 73 bips. So that gives you roughly 3 times 25 bips cut for the year, which are more or less the expectations that you're going to see from the dot from the Fed. So this is more or less what the market is pricing and what the Fed has been telling us for quite a long time. If you look at what they were already saying in September, those were the expectations. For the week, we moved for December from 469 to 460. So a bit down. So the Fed has been seen as more dovish than it was a week ago. What about the VIX? 13% for the volatility, very similar level. So we are still trading below the 15% level. I think one of the targets for, obviously from the FOMC meeting this week was to try as much as possible to dampen volatility as long as possible, at least, until elections, and make sure that everything is going to go smoothly. What about now we go into the technical analysis? We could be starting actually with something different, looking at the dollar versus the Chinese yuan. And this is a weekly chart. As you can see, we have been trading, kind of in a controlled way from the PBOC, from the Bank of China. And on Friday, this corridor has been moving a bit. So we have been weakening the Chinese yuan. As I said, the Chinese economy is still very much struggling, and they are trying as much as possible to restart the Chinese engine. And one of the ways is to weakening your currency and trying to make your exports cheaper. So that is really something to keep an eye on. Why? Because that could have an implication, especially in an election year where the candidates will be very keen on looking at how China could be using FX as a weapon. So let's go back into now the top, which is the S&P mini futures. Looking at the weekly, we are very extended. You see all those green candles since the lows at the end of October. Since then, only 3 weeks where we have been, kind of flattish, but most of the time we are up and up and up and up. So very strong rally. This is the same with the Nasdaq, where we made a very small new high. Russell 2000, the level is still the same. That's the 2100. So if we want to see the broadening of the US market, looking at the E-mini or the Russell 2000, that is obviously one of the places to look at. The FANG versus the rest of the market still doing well, and we're going to be looking. It's not because of Tesla, it's not because of Apple, it's because of, you're going to have Nvidia that is playing a big role, and the Meta and Amazon are doing well as too. So what about CL1? So actually, CL1, this 83 level kind of has been playing its role so far as the resistance. So that, again, for me, that is the level. If we go above the 83, then we can have another push. Copper giving back a bit of its performance from last week. The reason, as I said, is very similar to before. China is struggling. The numbers are not great, and when China is a bit of a not in recession mode, but not as strong as before, you don't need as much copper as usual. So gold, I think this one is an interesting chart. Why? Because you see this candle. This is a big rejection. We had a lot of excitement just after the FOMC meeting, saying this is dovish, this is very bullish for the gold. And I think the pain, if you look at 2-3% very quickly in big volume, and now I think there's a good chance that we're going to be testing again this 2080, which used to be a resistance, and now it's going to be a support. What about your dollar? Same picture. Don't want to be talking too much. Dollar yen, that is the one. As well, we've been keeping an eye. Why? Because the Bank of Japan came with decision on Tuesday saying that they're going to stop doing this very accommodative policy. Still, the differential in terms of rates between the Japanese economy, or the Japanese 10 years and the US 10 years, we are talking, 4.2% for the US, 0.7% roughly for Japan. So that gives you 3.5 differentials. That explains why the Japanese yen keeps on weakening. The 150, 190, 152 level, this is the recent highs. This is the where the market will be keeping an eye on, and probably where you're going to see more comments coming from the central banks and some politicians. Stocks, looking at the Philadelphia Semiconductor, a big candle, so some indecisions. We are consolidating at this level, so there is no follow-up. Nvidia could be making new highs next week, and I'm interested into JP Morgan just to tell you how strong this market has been. JP Morgan is almost up 50% from the lows of end of October, 50% in less than 5 months. Now it's trading on a PE on 12.5 times. From where I started, long time ago, banks are always been trading around 10 times. So I think there's a chance that it could be correcting by 20%. But for the time being, and going back into the 160 level, for the time being, this is a one-way traffic, similar for Europe with the Stock 600, and for the DAX that is making new highs and driven by very few names like SAP, for example. So going back into what happened for the week, so looking at the S&P 500 futures for the last 5 sessions, so that will be here. As you can see, before the FOMC meeting, we're kind of going a bit higher every single day, not that much, and then we get this acceleration. Not only because the Fed was pretty dovish, but I think the positioning going into the FOMC was a bit of wait and see. So looking at the comments of the FOMC, the Powell comments were higher inflation, higher growth, but despite all of this, they want to be pretty dovish. So it's pretty clear that the Fed is making the market and the expectations now for inflation to be staying above 2% for longer than usual. So that means your natural interest rates, which is your R star, is going to be above 2% for quite some time. And if you look at the dots from this week, the Fed is only expecting the 2% to be reached, I think, in 2026. So overall, that explains the risk on that we had on the S&P. In the meantime, on Thursday, we get the SNB, which is the Swiss National Bank, which unexpectedly cut rates by 25 bips. So this is the global easing. Next, we're going to have the question, is it a race to the bottom? And, who's going to be cutting the rates as quickly as possible? Next is going to be the ECB. The Bank of England as well has been saying that inflation is coming down, that we should be expecting cuts coming. So overall, very accommodative central banks. What about, what is the underlying economy telling us? Because we knew that retail sales in January and February were not that great, and the confirmation that we saw some retail retailers came out with their numbers. So we started the week with Kering, with Gucci in Europe. So, people were saying, oh, it's a company specific because Gucci, you like it or not. So the stock was down more than 10%. And yesterday we had 2 warnings of slowdowns, both from Nike. So maybe it's another company specific, and another company specific, which is Lululemon, which was saying their growth, instead of it being 15% and 20%, as it was in the past, we are talking more 10% in the future. Still very strong, but that means suddenly you go from a P of 38 times to 34 times. And those 3 names, are they still company specific if we are talking Gucci, if we are talking Nike and Lululemon? So overall, the question is more or less the same. What is driving this market? If you look at those 3 charts here, as you can see, Kering, Nike, Lulu, since the start of the rally that we had at the start of November 2023. Now all those 3 are flattish. So market is not driven by retail. It is mostly driven by big tech. So big tech Q4 2022, and this chart is really good. This table is really good. It's coming from Barclays, explaining where is the growth coming from. It's all about big tech, okay? And the big tech, it's mostly Nvidia, it's mostly Meta, Amazon, that are explaining the big chunk of the raise in earnings. If you look at the rest of the S&P, actually earnings have been down. So very few names are driving this market. As long as the story and the price action of those names is the same, there is no change. So what about this week going forward? This is a short week because we have the Good Friday this Friday, so the markets are closed. Usually this is, for all of us to go back to church and pray for our sins. And what is interesting is if you look at where are the big numbers, it's on Friday, the personal income or PCE. So actually the volatility for the week, as this is a shorter week, is at 0.9% for the S&P. That means probably, if you are looking at options, there are some plays between Thursday expiry before PCE and next Monday, which will be after PCE, the way the implied vol is played. Other than that, what is interesting is we have a lot of options, not of bonds auction. So we got 66 billion 2 years, 67 billion, 43 billion. So tons of supplies. As always, we would like to see how this supply is meeting demand, and because it could have some implication for the other asset classes. But overall, the other leading indicators, we don't have that much. We have a bit of housing and a bit of Fed indexes that are coming. Finally, as we don't have that many catalysts, we know what are the end of the month rebalancing telling us this is a strong month. So we could see some selling of of stocks going forward just for the rebalancing. I'm still looking at the same story, which is, momentum are the leaders,
13
still
victims
leading.
Of mass kidnapping are located
And to me,
in
this is really important. Are the Nvidia, the momentum still doing the same picture? Looking at, what was a leader not so long ago, which was Apple, I'm looking at the divergence that we start to see over the last 6 weeks. And the same with Tesla. There has been some specific, because, the US government is going after the size of Apple. But, it's the same with Tesla. The earnings have been coming down. So there is correlation, believe it or not, sometimes between the stocks, how the stocks behave, and earnings. So I'm looking at this big company, which is Apple, versus the overall market. So this is it for me for this week. If you look at cocoa, you look at the prices that have been on the way up, and that means chocolate, and the prices of chocolate are going to be massively up in the next 3 to 6 months. Why I'm saying that? Because, for your Easter, you could have a 25% discount on the 4x4 trading course. So you could have access to more than 30 videos or 40 videos, even 50 Excel spreadsheets. You will have access to 20 more channels on the Discord community. This is a growing community. So this 25% discount, if you use the coupon code Easter25 before the 7th of April, you could benefit from it. Overall, this is it for me for this week. Next week, this is a long weekend, so there's not going to be any new video from me, and I'm gonna be catching up with you in a couple of weeks. In between, have a good trading week and have a good some time off with your family over Easter. All the best. Bye bye.